Welcome to the deep dive. Today, we're taking a closer look at Deliveroo. We'll be drilling down into their 2024 annual report.
Yeah, these reports are, packed with detail.
Exactly. Lots of information on how the business is performing, their sort of big plans, and how they aim to create shareholder value. So our mission today is really to pull out those key insights, understand where Deliveroo stands now, and where they're heading.
Definitely. Annual reports, they can seem a bit dense, can't they? But they really do give you a good peek under the hood. We'll be looking at, how they actually make money, the business segments, the key financials for the year, and of course, their strategy going forward.
Okay, sounds good. Let's start with the basics then. How does Deliveroo actually, operate? They call themselves a hyper-local global online platform.
Right.
It's an interesting mix, that global reach combined with a real focus on the local level, consumers, restaurants, shops, riders, all in one community.
That hyper-local bit is crucial, isn't it? What works in London might not work in, say, Dubai. So that local approach is key for a global player. And a really big strategic goal for them is becoming a plus-first business by 2026.
Plus first, so for users, that means most orders coming from Plus subscribers.
Exactly. They want the majority of transactions flowing through their Deliveroo Plus loyalty program.
And they've been really tweaking that Plus program in 2024, haven't they? Sounds like it's more than just free delivery now.
Oh, absolutely. They've really powered up the Plus Gold tier in the UK and France. They added an on-time delivery promise for restaurant orders and a credit-back system if they miss that window.
Interesting. And did that work?
Apparently, yes. The report mentions a 30% rise in paying Gold subscribers in those areas. And importantly, these subscribers, they're ordering twice as often as pay-as-you-go users.
Wow, double the frequency. That's significant.
Yeah. It really is. Shows the loyalty push is working. And they didn't stop there. They also launched a new higher tier called Plus Diamond. This one's aimed at, the really frequent high-spending customer.
Okay, so what do they get?
Exclusive merchants, an even better on-time promise, special customer service. And these Diamond members, they order more than twice as often as even the Gold users.
So it's really about layering the value, rewarding those top customers. Now, beyond subscribers, Deliveroo is also making a big move into retail.
A huge move. They more than doubled the number of retail sites on the platform in 2024.
Doubled. Like, who have they partnered with?
Well, in the UK, you've got names like B&Q, The Perfume Shop, Wilko, even not on the high street. And in the UAE, partners like Holland & Barrett, Toys R Us, Lush, pharmacies.
Right, so it's broadening out way beyond just takeaway food. Getting groceries, maybe some DIY stuff, gifts.
Exactly. Tapping into a much wider range of sort of immediate consumer needs. If you need something fast, maybe Deliveroo's an option.
Makes sense. Convenience is king. Now, all these extra deliveries, restaurants, retail, efficiency must be absolutely critical.
Oh, massively. They're really focused on delivery efficiency. One big thing is the rollout of multi-pickup stacking.
Stacking, so riders grabbing multiple orders at once.
Yeah, pick up from maybe a couple of restaurants or shops, then deliver to different customers along an efficient route. The report says these stacked orders increased significantly year on year.
Saves time, saves cost, presumably.
And potentially gets orders to customers quicker sometimes. They're also using better data to cut down rider wait times at merchants, things like an order ready button for restaurants, rider check-in features, apparently shaved wait times by 3% year on year.
Every little bit helps in that game, I imagine. What about behind the scenes? Any efficiencies there?
Definitely. They mention improvements in marketing, better tools for targeting, creating campaigns, getting more bang for their buck, essentially. And also streamlining overheads. They're leveraging their tech hubs in India and Manchester, using more self-serve tools internally, automation, standard efficiency plays, really.
And AI. I saw that mentioned. Where does that fit in?
Yeah, they're looking at AI quite seriously. They mentioned AI agents for some customer service tasks.
Right.
And maybe even helping with discovery and ordering in the app. Also as a sort of co-pilot for their tech teams, helping with coding, updates, reviews.
So freeing up human developers for more complex stuff.
Pretty much. It shows they're thinking about how tech can reshape the operation down the line.
Okay, so all these strategies, loyalty, retail, efficiency, AI, they must tie into some financial goals.
Absolutely. They've set medium-term targets. They're aiming for mid-teens percentage growth in GTV gross transaction value.
That's the total value of all orders, basically.
Exactly. Mid-teens growth there.
Right.
And an adjusted EBITDA margin of over 4%.
Right, 4% plus. Those are the key numbers to watch.
Those are the benchmarks they've set, yeah.
Okay, great overview of the strategy. Let's dig into those 2024 financials now. What were the headline figures?
Right, the numbers. So GTV hit 7.4 billion pounds. That's up 6% versus 2023 if you adjust for currency changes.
Okay, decent growth. Revenue.
Revenue was 2.1 billion, up 3% on that same constant currency basis. Gross profit landed at 767 million, which is about 10.3% of GTV.
And the bottom line? Or, well, adjusted EBITDA anyway.
That's the big story, really. Adjusted EBITDA came in at 130 million. That's 1.7% of GTV, a huge improvement from previous years.
130 million. That is a big swing. Did they actually make a net profit?
They did. For the full year, combining continuing and discontinued operations, they reported a profit of 2.9 million.
Wow. Compared to what last year?
A loss. Compared to a loss of about 31.8 million in 2023. So yeah, turning profitable is a major milestone.
Definitely. So what drove that turnaround? What were the key reasons?
Well, several things. That improved GTV growth was a factor, mainly driven by the UK and Ireland, and also international markets, if you exclude Hong Kong. And importantly, order growth actually returned, up 2%. So more people ordering.
Okay, but revenue growth was a bit slower than GTV growth. Why was that?
Good point. Their revenue take rate, the slice Deliveroo takes from each order, actually dipped slightly to 27.9%. They said this was mainly because they invested in, customer value promotions and offers,
Right.
and also a higher mix of grocery and plus orders, which tend to have a slightly lower take rate for Deliveroo.
Ah, okay. So investing in growth and loyalty maybe squeezed the margin per order a bit.
Kind of, yeah. But it was partly offset by growth in advertising revenue. That hit 1.4% of GTV in the last quarter, so that's becoming a more meaningful contributor.
Interesting. So new revenue streams helping out. And how did profitability look across different regions?
The international segment showed really good improvement in gross profit margin. It reached 9.6%.
And that was down to,
Mainly those delivery network efficiencies we talked about, the stacking, reduced wait times, etc. And that improvement, plus better overhead control internationally, really helped boost the overall adjusted EBITDA figure.
got it. So the strategic moves seem to be paying off on the bottom line. Okay, let's switch gears slightly. Shareholders, what's the plan to create value for them?
Well, a big part of it is share buybacks. They announced a $150 million program during 2024.
Right, returning cash to shareholders that way.
Exactly. And they've also signaled another one up to $100 million planned for 2025. It shows confidence in their own share price, and it's a direct return of capital.
Makes sense. Buybacks reduce the share count, can boost earnings per share. What about dividends, though? Any direct cash payouts?
No, the report is clear on that. No dividend paid in 2024 or 2023.
And the reason?
Their thinking is that the online food category is still pretty early stage, lots of growth potential. So their priority right now is reinvesting cash back into the business. They believe that maximizing long-term free cash flow per share through investment will ultimately deliver more value than paying dividends now.
So growth first, dividends maybe later.
That seems to be the message. They'll review it, but don't expect dividends in the near term.
Okay. And there was something about their stock exchange listing, too. A
Oh.
change.
Yes. In October 2024, they moved their listing on the London Stock Exchange up to the premium commercial companies category.
What does that matter?
Well, it made them eligible for inclusion in the big FTSE UK index series. And they actually joined those indices in December 2024.
Which means more index tracker funds have to buy their shares. Potentially boosts demand.
Yeah, that's generally the idea, yeah. Broadens the potential investor base.
Right. Okay, pulling it all together then, what's the overall assessment looking forward? How's Deliveroo positioned?
Based on this report, the company seems pretty confident. The buybacks signal that. Their strategy seems clear. Focus on loyalty with Plus. Expand selection through retail and other merchants, and keep driving those operational efficiencies, the operating leverage.
And those key metrics, GTV growth and adjusted EBITDA margin, are the things to watch.
Absolutely. They're clearly still investing in what they call CVP, customer value proposition, to keep that growth engine running too.
And the board seems happy.
The report includes the usual statement saying the board believes the accounts are fair, balanced, understandable, and give shareholders the info they need. Oh, and one sort of post-year-end thing worth noting, they did announce they're exiting the Hong Kong market, so some strategic refocusing there too.
Right, okay. So wrapping up, the main takeaways seem to be a big push on subscribers via Plus, major expansion into retail, that constant drive for efficiency, and shareholder returns coming through buybacks for now, not dividends.
Spot on. Plus those medium-term targets for growth and margin improvement.
It definitely leaves you thinking, doesn't it? This whole hyper-local delivery model,
Hmm.
what's its real long-term potential in a consumer world that's changing so fast?
Hmm.
And how do companies like Deliveroo find that sweet spot between pouring money into growth and keeping shareholders happy with returns?
It's a tough balancing act for sure. Definitely a dynamic space to watch as Deliveroo keeps evolving.